Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network team consists of Karl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed & Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
Hi there, welcome to the Expert Network Team's meeting. We're going to do something a little different this time. We're going to do, what do you think? And I think Karl has our topic for the day. Karl's with A&I Financial Services. With us also is Nate with Goodspeed & Merrill. And what do you think? And I think Karl has the topic of income from owning property in retirement.
Well, just real quick, I think what that means is Karl's got the only thing we're thinking about that we can talk about without having a highly edited episode. But
that is absolutely true. We could go on and on for great lengths about inappropriate.
We all know that we can't leave me unscripted. That's the problem.
Nate unscripted topics is a yes
dangerous world.
It's an entertaining world.
It's an entertaining and educational and insightful.
Yes. Well, I am really interested in this idea because it's something I've been thinking about a lot. And so, as you all know, I spend all my time thinking about retirement income for my clients. And I've got a wide spectrum of clients. And a lot of them never retire, right? They just own a business throughout their lives. And some of the businesses that they own are real estate. And so I'm thinking about it for myself and our own business and our own family. And I'm thinking about buying real estate. And I'm thinking about buying income-producing real estate. And in Denver, Colorado, that's actually pretty hard to do because, the way they measure your income on real estate is something called the cap rate. Well, the cap rates are crazy low. The prices are crazy high, and you're kind of nuts to pay these kind of prices to buy this little tiny income. I can go elsewhere.
But yeah, let's talk a little bit about that, kind of put that in layman's terms, because what that essentially means, whether you're talking about a big building or a small house, is how much capital, right, does it take to put into the asset to acquire it versus how much income is coming out of that asset. Right. So obviously the best solution is to go into an asset with as little capital as possible, but it produces the highest amount of income.
And, there's a positive relationship between the amount of risk you're taking and the higher the cap rate, right? You're not going to get a really good cap rate and really good income off of a high-quality property.
But some of that is dependent on how you derive your income. And sorry to, but because, and this is going to depend on the type of real estate asset you're looking at. It's going to vary between single family and large commercial building.
Right.
You can derive income from the rents, which is obviously a nice passive revenue source, or you can flip. And in a market like Denver, you might be able to reuse capital over and over again if you're in the flipping.
What's a flip?
Not even a flip. It could be like a 1031 exchange. You could flip for gain and sell profit, or you can
just a short-term hold is basically
just a flip being a short-term hold, sell, make a profit, walk away.
Right. Because the market makes your money for you. It's not an active income stream without the actual transaction. Whereas the normal way of looking at real estate, and I think this is where you wanted to go with this, but I'm just showing how the income can come from other places, not just a rental stream, but just you hold it for 2 years, you play the sale, you play the appreciation.
I love it.
Or you can play both. You can model out your income from both appreciation and
the possible sale in the future.
Well, and the rental income, yeah.
Right.
So the sale plus the rental income is your total ROI on your capital.
Can I take 2 steps back? And Mike, you might be the best one to answer. But what do you mean by flip, and what do you mean by 1031?
So for a flip, you buy an asset, whether it be a residential property or commercial property that's probably in a higher cap rate, right? It's a little dilapidated, needs a little bit of work. You need some higher quality tenants in there. So you're going to acquire this asset at a higher cap rate, lower acquisition cost. You're going to improve the asset, right? Clean it up, repaint it, put new fixtures, all that stuff in, get some more better quality tenants in, which are paying higher rents, which therefore reduces your cap rate, right? Because now you're making more money on that asset, makes it more valuable. Somebody wants to buy it because you've already improved it and improved the income process. Then you turn around and sell it for a higher sales price, and not only recoup your costs and your price, but you make a significant profit on it.
Don't have to pay a huge amount of taxes when I do that?
Yeah, well, if you hold it for more than 365 days, you have long-term capital gains rates. If you do the traditional flip, like if you just buy a home and fix it up in 3 months and flip it, you're going to pay ordinary income tax
Right.
rate on that, right? Some of your larger real estate investment trusts basically do the model that we just talked about a minute ago, where they buy it at a high cap rate, fix it up, then they either sell it and take the money and do whatever with it, or they convert it into a 1031 exchange and buy a higher quality asset.
So,
Right.
so what's the 1031 and what's the big deal on that? Either of you, gentlemen?
So 1031 exchanges, you're basically avoiding taxation by trading one asset for another. So if you buy a commercial building and you've got it to the point where it's more valuable, significantly more, or more valuable than what you acquired it for, and you want to move from, say, a 16-unit commercial building to a 5-story, 400-unit building, right? You can trade up in what's called a 1031 exchange. So you sell your existing asset, acquire the new asset, and there's no taxation in that transaction to the extent that you don't receive any cash out of the transaction.
I love it.
At least not initially. And this is where a lot of people get stuck on 1031s is they'll upgrade that asset. They've got a lot of equity in. They load it up with debt maybe a month after, 2 months after. They pull that debt out. And, I mean, this gets into some of the more technical aspects of tax accounting. But if you pull that money out on a refi, it's not tax deductible, right? Because it traces back to...
It's not, if you refi it and you take the money out of it, it's not taxable at all.
No, but the interest isn't tax deductible if it's pulled out and it's not acquisition debt. If it's just
Correct. Yeah, it has to be acquisition debt, interest associated with acquisition debt in order to be deductible.
Right.
Correct. Yes.
And so then what happens is they've got that property now loaded up. They may have low or zero basis, and so they have a basis problem after a while. So it just depends on how often they're doing that. And then you roll it forward with the 1031 exchange. You always have to exchange over, like, to the new asset equal or greater in equity and debt. So you either have to take on the same amount of debt in the new property or more debt, or the same amount of equity or more equity. If you ever pull either of those down, you're going to have taxable income that results.
That stinks.
Well, it's deferral.
It's deferral, and you should have to plan it. You have to run the numbers and plan it. You have to work the numbers and make sure that everything factors out. And that any tax hit that's potential out there, you're aware of and you're willing to accept that.
Is that called boot?
Yes.
Yes.
And what's the tax rate on that?
It's long-term capital gains.
Yeah. If you've held it more than 365 days, it's long-term.
So one of the cool things that I keep hearing about real estate, and guys, I'm playing a little dumb on this, but I really kind of am dumb because I play the vast majority of the Frank family wealth is in the same investments that I do for my clients in marketable securities. But guys, this idea of only being able to 1031 into bigger and bigger buildings just seems like I'm getting more and more complicated.
Yes. Either way, it's going to get more complicated because you can either go up in kind of value of asset, or you can diversify it more. So you could take a large building and break it up into 50 single-family residences if you wanted to. And I mean, I have some clients that have, 20, 30 million in single-family residence assets. That's what they know. That's how they started it at 19, and they've done it, and they've never aspired to move into self-storage or industrial complexes or that sort of stuff because they know real estate and they have a property management company set up. They can do it. So you can grow an enterprise, or you can grow that ultimate retirement income that I think you want to talk about.
Oh, yeah.
Off of very small assets, just leveraging it over time and growing it and taking advantage of those tools like the 1031 to just create a broader base of income.
I love
Whether that broader base is a bigger asset or more, depends on how you function. Because you can, again, it doesn't have to be a single asset for a single asset. It just has to be like kind for like kind. So it can be one asset for 10 or 10 assets for one.
Right, and as I recall, you got a certain window that you can do that in. Like if you're going to do a 1031, you can't just wait 5 years.
No, I think it's 180 days.
Yeah, you have to. This is the biggest pitfall of 1031, especially in a market like this. If you plan on doing a 1031 in a tight real estate market, you're gonna get bit because you have to identify your replacement properties in 45 days, and of those properties you identify, you have to close on them. And so and there's a couple of different ways you can do this. There's a 3-property rule where you identify 3 and you close on 1 or more of them. There is the 200% rule where you can identify properties equal to 200% of the value you're exchanging, and you have to close on those properties. Or you have to do what's called the substantially all rule, which is something, it's a little more gray in terms of how it works, but if you identify more than 200% or more than 3, you have to close on substantially all of those. In a tight market, that's never going to happen.
No kidding.
It's a very small window to make that work.
So you have to plan ahead. I guess this is the emphasis of in my voice is you don't just think after the fact, hey, I'm going to do a 1031, because you don't have the time to usually find the right properties, because then you have the tax tail wagging the dog. You're just buying anything you can identify that you know you can close. You want to be more prepared than that. You want to have your replacement properties lined up, ideally, before you ever sell your property so that you know you got assets you're going to want. The other way to do that is a reverse exchange where you actually acquire through a qualified intermediary your exchange replacement property first. This takes usually some resources, but you can actually buy the property you want to exchange into first, sell your property, and then move the money over to your new asset. So that's the safest way in a tight market.
Well,
if it's a flush market, then you can go crazy. You can do whatever you want. But in a tight market, it's tough.
So a couple things in there. One is to do a 1031 exchange, you have to have an intermediary do the transaction for you. That's a requirement. The other one is I get a lot of questions where people have their personal residences and they go, I'm just going to do a 1031 exchange. You can't. It has to be a business asset. You can't do a 1031 exchange with a personal residence.
Business or investment, yeah.
I love it. Well, holy cow, guys! Thanks so much. I'm really glad I asked those questions. But I'm not planning on selling this thing. Right. I'm planning on
riding into the sunset,
retirement income off this thing, and I love diversification, but diversification of real estate kind of scares me. It sounds like a lot of work. I got to do a lot of property management and fix the toilets and take out the trash and repair the doors and kick out the tenants and get new tenants. And it seems like work. So it seems like if I have one building or if I can do that and own it for the rest of my life, it seems like I might be in better shape. What should I be looking out for?
Well, you should be looking at a different mindset on diversification, because diversification could be by the asset, but when you're talking about a larger building, it could be by tenant.
Oh.
So in a commercial building, if you have a single tenant building, you're not diversified. You have one building and you have one tenant, and everything's dependent on that relationship staying intact.
You have one tenant, and if he or she's out, you have no income coming in.
The building's kind of empty.
Yeah.
Right.
So your need to diversify obviously depends on the creditworthiness or strength of the tenant. But if you have a single asset that has 4, 5, 10 or more
8,
tenants,
16 units.
yeah, then it's like having 5, 10, 12 different assets in a single building. So because you're diversified across tenant base as opposed to across the actual physical asset.
Right. That makes perfect sense.
So it's, risk mitigation. Yeah. If one person's out and you have a 16-unit building, you still have 15 people.
Yeah, that
rent.
doesn't seem like a whole lot of risk.
And that's one of the reasons why multi-family buildings are interesting for those who graduate out of the single-family construct. You have a single asset, a multi-family complex that has 20 tenants.
20 different income sources.
Right.
And one roof to fix.
Right.
And you as the owner of the building really should just hire a property management company. I own real estate. I'm not the guy that goes and fixes it.
Good for you.
I have a property management company.
How much do I have to pay them?
It depends. If you get good quality, reputable property management companies, it's usually average about 10% of whatever the rents are that they collect.
Man, that's a no-brainer for me,
And that's just the management fee that they provide to manage it.
right?
If you have actual expenses like the yard needs to be cut or some repair has to happen,
Snow.
you're paying for that outside of the management fee. But
Got to move all that stuff out. Yeah, I got to move the snow out. Got to mow the lawn. So talk to me about the income that I get, because one of the things I hear from all my clients who own a lot of real estate is that they get a big tax advantage on the income they get from their real estate. How does that work?
so the income they get is deemed passive because it's rental income. So it's not subject to self-employment tax. There's no Social Security, Medicare tax being hit on that.
What's
So-
that? I mean, just so people get an understanding, because again, most people aren't aware of the rates they're being charged on that kind of stuff.
If you're self-employed and you have to pay the self-employment tax, it's basically your Social Security and Medicare, which is 7.65%. And if you're self-employed, you're paying twice that because you're paying not only your employee contribution, but the employer contribution, so it's times two. So it's 15.3%.
Is what you're saving.
Yeah.
That's a pretty big savings.
Pretty good chunk. Plus, when you own real estate, you get the depreciation, which is like a paper write-off, right?
Over how many years?
It
Typically?
depends. If it's residential, it's 27 and a half, and it's commercial, it's 39 years. Downside of that is if you do sell the property at some point and not do a 1031 exchange or not pass it on through inheritance in some way, you do have to recapture depreciation if you sell it.
And what rate do I capture at?
25%.
Yeah, so that's kind of a bummer. But it's about the same as long-term capital gains
Right.
rate if you're in a higher income tax bracket. So if I buy a property for $1 million and it's residential, I divide that million by 27, and so it'd be roughly 30 some odd grand that I'd be able to reduce my taxable income by this year.
Yep.
And if it were commercial, I'd divide it by approximately 40. It's 39 and
Right.
something, right? So I'd still get a pretty good deduction on that too.
And if
That's
you
not
leave
bad.
if you leave it as an inheritance tool, right, as an estate planning tool, which Nate's probably very familiar with, and like I give my rental, like I pass away tomorrow and my kids get my rental properties, all the depreciation's wiped out. They get step up in basis, and it starts over again. The clock starts ticking. So they could literally acquire all of my assets at my date of passing, sell them all, and not pay any taxes.
Yeah, we should do a separate episode just on how, with this particular type of investment, for people who have this kind of asset, how the swap till you drop versus using a deferred sales trust can factor into how the plan works. Because conceivably, with a deferred sales trust, you can move that depreciation, that basis reset, to while you're alive and still preserve some step up in basis. So you can almost get the best of both worlds if you're willing to do a little bit of planning.
Guys, that is a great topic. Let's talk about that one next time. What else should I know as a novice real estate investor looking for retirement income, passive retirement income with a little bit of depreciation that'll give me some tax advantages?
Well, I think one of the reasons why real estate's such an attractive retirement, I mean, because you're couching it as retirement income. It's income.
Oh, yeah.
But it's in a retirement strategy. One of the advantages to real estate is your ability to ratchet up the income with cost of living, basically.
So I can actually have an inflation-protected income stream.
I think that's one of the reasons why people look to it a lot as retirement income, because it's somewhat dependent on the market, but ultimately, historically, cost of living, rents have always gone up.
Yep.
They've rarely gone the other way, and only for brief periods of time. So you do have that inflation protection built into the asset, not only from the appreciation standpoint. Some assets, like I know a lot of folks who are investing in Tennessee for some reason, not a lot of appreciation out there, but a lot of income
Get more
flowing off
income.
of those assets. So you just have to kind of understand the market.
What play do you want to do? Do you want the appreciation or do you want the rental income?
I want simple.
Yeah.
I want simple. Less stress. I know that when we do our financial planning projections for folks for retirement, that even a little bit of steady income can make a big difference on what you do with the rest of your investment accounts. So you can invest them for growth. You can invest them to keep you ahead of inflation, and you can invest them for your legacy and tax advantages and everything else.
So probably one other maybe closing thought that I think factors into some of the stuff you're working on is, what if you don't have the financial wherewithal to buy a nice big building? And I happen to know this because we're working together on this project, but you can actually, if you're willing to put together a group of investors, people you know and trust and think you can rely on for the long term, you can probably find yourself into bigger and bigger assets without the time runway that's involved in usually building up that equity, unless you come into it through inheritance or something like that, which is obviously a great advantage. But if you want to go into a $4 million project and you don't have that kind of down payment, you're going to have to come up with assets from other sources, obviously.
Right. Or you're not willing to take on that kind of debt all on your own.
Right.
Diversify the risk.
Right. Diversify the risk.
So diversification comes into play on both sides. Don't do the whole thing yourself, and don't rely on one source of income for the thing.
Sounds like a great plan. Thanks, guys. Really appreciate it. Always great to see you.
All right. See you next time.
That was relatively not controversial. I think we did all right on that.
We
what
did
are you
really
thinking?
good.
Yeah.
Good job, Nate. Hey, create a beautiful day. Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.